If you bought $10,000 of Apple in 2006, it'd be worth $1,166,000. I bought 2,800 shares on January 17th and another 2,800 shares on the 20th. Now keep in mind this is pre-iPhone. The thesis at the time was really how the iPod was taking over music. Steve Jobs was the largest shareholder of Disney, and Apple really seemed poised to dominate digital media. And this mostly came true with the success of iTunes. Apple's set to announce earnings in 2 days, so let's do a discounted cash flow and see if I should keep my bags or sell them. The Wall Street Journal did a good job in an article today talking about how the services division of Apple, really its growth engine, is under threat. Services are things like the App Store, Apple TV, and the Google search deal. Services was 30% of gross profit in 2019, but it's grown to almost 40% of gross margin in 2024. Let's dive into a quick DCF. Market cap $3.2 trillion, 100 billion buybacks authorized, 100 billion annual free cash flow. They're returning cash to shareholders. People are holding on their iPhones longer, but they are extremely loyal, 97% loyalty rate in the US. Their gross margins are an impressive 47%, but services is an incredible 75% gross margin. And my favorite metric for a business like this, the return on invested capital, ROIC, is 33%. The way to think of ROIC is it's like if you were an investor and you could do a 33% return on your capital. So a conservative base case of 5% annual growth on the top and bottom line for 5 years, and a 2% terminal growth with a 9% discount rate, which is the weighted average cost of capital for Apple, gives an intrinsic value of $210 per share. That's actually pretty darn close to where today's value is. Now, the bull case isn't that crazy either, though, at 8 to 10% growth. And if I change the cost of capital to 8% instead of 9%, then all of a sudden you have an intrinsic value of $250 to $270 per share, a nice upside. And even in the most disastrous situation, the intrinsic value still comes out to $160 to $180 per share, and that's some real wheels falling off the bus. So the bottom line is Apple's a high margin, high return on invested capital fortress. It's not a bargain, but steady growth, and $100 billion in buybacks make it a strong long-term play. And I think it's more than likely Apple has a few tricks up their sleeve we don't even know about. After all, the iPhone came out of nowhere when I made my investment in 2006, and boy, am I happy it did.